Today, we're diving into what will 2025 mean to multifamily investments and to investors like you. A year that's bound to shape up to be both a challenge and an opportunity for investors. Stick around because what I'm about to share could be the game changer you need for your portfolio this year. Welcome back to the Apartment Dealer Show, where we help multifamily investors like you build and preserve financial legacies in multifamily real estate. As we embark on a new year, I want to start by surveying the landscape of the apartment market here locally in Southern California. There are, in my best estimates, challenges ahead that are going to serve as a double-edged sword. We are going to experience things that will impact cash flow negatively and that will serve as an opportunity to find good purchases. Let's first start with a look back at 2024. Last year, the multifamily market saw a major shift. Demand for apartments hit its highest level in nearly 3 years, with about 660,000 units absorbed, far outpacing the 590,000 new units delivered nationally. This pushed national occupancy rates to 95%. But even with strong demand, rent growth still stayed at just 0.5% because of the flood of new supply. In Southern California, Los Angeles absorbed over 3,000 more units than were built, proving that demand is still solid in key markets. However, we only saw a mere 0.1% rent increase, showing how supply pressures are holding back rent growth. Now, here's the real shift. Even with rising interest rates pushing property values down, sales were still up 10% year over year. Why? Because sellers finally realized they can't sell a 4% cap rate when interest rates are above 6%. Some sellers are coming to terms that values are not what they were a couple years ago. And for those sellers that cannot come to terms with that, their properties are sitting on the market longer, and in the end may sell at even lower pricing if they do not make the tough decisions now. In my upcoming market update video, I'll break down sales volume and pricing in your area. But here's one takeaway. The market has officially shifted into a buyer's market. As we continue through 2025, your success will depend on strategic property management and smart acquisitions in high demand areas. Now, let's take a look ahead as we continue through 2025. Let's first start with the economy. On the surface, the job market looks strong with record high employment, but dig deeper and you'll see cracks. Consumer credit is at its highest level since 2011, and car repossessions are nearing record levels. These signals suggest financial strain for many households, your tenants included. As landlords, it's critical to understand this dynamic when managing rents and collections. Looking further ahead in 2025, the economy is sending mixed signals. On one hand, growth is expected to pick up slightly, but on the other hand, massive budget deficits could slow things down. Now, some say the Trump administration's push for tax credits, cuts, and deregulation, while giving the economy a short-term boost, could actually be canceled out from the blowback from higher tariffs. Time will tell how that plays out. But we do know the Federal Reserve is holding back on more interest rate cuts, keeping borrowing costs higher for longer. Now, as we turn to commercial financing, let's take a look at loan maturities. By the end of 2025, more than $1 trillion in commercial real estate loans will have matured. That's right, $1 trillion. And guess what? Many of these loans were extended during the high interest rate environment over the past few years. Borrowers are now feeling the squeeze. Why does that matter to you? This wave of loan maturities could be a catalyst for sales activity. Properties tied to underperforming loans are hitting the market, presenting an opportunity to acquire assets at attractive pricing, especially in high growth markets. Imagine you are an investor who purchased or refinanced a property 2020, 2021 at 3%, and now that it's adjusting to 6.5%. Do you know what kind of hit that is to cash flow? Not to mention, if that investor did not do a good job raising rents over the course of the last few years, chances are they cannot qualify for a new loan. But here's the catch. Interest rates most likely will remain elevated throughout this year. As of today, the average rate for a $1 million loan, commercial loan, sits at 6.5%. The Federal Reserve has hinted at slowing rate cuts in 2025, again, keeping these borrowing costs higher than we'd like. So the key is strategic acquisitions. Look for properties with strong fundamentals, prime location, high tenant demand, and efficient operations. Now, let's discuss shifting renter behaviors. Here's an interesting shift. Renters are staying in their units longer. According to recent data, about 34% of US renters have stayed in their unit for at least 5 years, with 16% staying a decade or more. This trend is partly driven by high mortgage rates and home prices, which are keeping many renters from making the leap to home ownership. Now, many of you are thinking, my tenants have been here for two decades or more. Well, that could be a reflection of the area, the local rent control, or the quality of the tenant. What I'm referencing here, the shift, is B plus, A plus locations, and good quality properties and desirable tenants. They're staying longer. If you've been following my show for any length of time, you know that millennials seem to flock to my personal rental units. So we have working professionals with good income, job history, credit, all of the rest, who otherwise would have bought a home by now. But given the affordability issue, they have no choice but to hunker down. And when you're on the upper end of the spectrum, like I am in terms of the rental rates, they are not staying for the discount, but because we are offering a quality asset. What does this mean for us as landlords and investors? Stability. Long-term tenants mean fewer turnover costs and steadier cash flow. However, it also means we need to focus on tenant retention. Are you offering the amenities and service that make renters want to stay? In other words, is your unit a tiebreaker when tenants have a choice? Let's move into multifamily market trends. The multifamily market sector is navigating a delicate balance of supply and demand. Construction of new units is slowing, with 2025 projected to see a 20% decline in starts. For investors, this is good news. Less new supply means tighter markets and potential rent growth. And when it comes to rent, Southern California counties are expected to see modest single-digit increases through about mid-2026, with the Inland Empire leading the pack at 7%. Why? Because renting remains far more affordable than buying. In Los Angeles, for example, owning a home costs 35% more per month than renting. And with 80% of homeowners locked into a mortgage of, say, 5% or less, inventory remains tight, pushing more people towards rentals. Now, regulatory pressure remains a major challenge for multifamily investors. More and more cities are implementing individualized rent control ordinances. Take Los Angeles County's unincorporated areas. They've introduced a new rent increase formula of just 60% of the consumer price index, or a 3% cap, whichever is lower. With today's CPI at 2.9%, landlords can only raise rents by 1.74%. That's right, less than 2%. That is precisely why I'm selling my last property in East Los Angeles. The rent control environment is making it nearly impossible to maintain a healthy ROI in these areas. Not to mention property insurance. Securing property insurance for multifamily properties in California has become increasingly challenging and costly. Insurers are scrutinizing property conditions more rigorously, leading to non-renewal notices for issues such as outdated electrical panels, aging plumbing, deteriorating roofs, or even trees overhanging rooftops. For instance, properties with older roofs are facing unexpected policy cancellations based on satellite imagery or drone inspections. In 2024, this trend intensified with major insurers like State Farm announcing the non-renewal of 42,000 commercial apartment policies across California, effectively withdrawing from the state's commercial apartment market. This wave of non-renewals has left property owners scrambling to find coverage, often at significantly higher premiums, which in the end impacts the financial stability of multifamily investments. So now, with this information in hand, let's talk strategy for 2025. When I sit down with landlords and ask why they chose to invest in multifamily properties, the answers usually fall into three categories: cash flow, appreciation, and tax savings. But let's be honest, cash flow is king, and rightfully so. For the amount of time, energy, and risk we take on, especially here in California, with endless tenant protections, rising costs, and regulations, we deserve a solid return. That return comes in the form of reliable cash flow. At the end of the day, these properties, no matter how nice they are just bricks and sticks. They're a vehicle, a tool to help you achieve your ultimate goal, building a financial legacy. And I get it. Some properties carry sentimental value, and I'm not dismissing the time and effort you've poured into them. But let's zoom out for a second. There are thousands of properties out there that can reach your financial goals. The bigger picture here is about the life you're trying to build, not just holding on to a property because you've always owned it. So here's the question you need to be asking yourself this year. How much income do you need and by when? Is it a specific retirement date, a certain income level? How many units will it take to get there? You need to know these numbers. If you believe that owning a certain number of units will give you the cash flow you need, then it's time to map it out. And beyond just the numbers, what will that income actually mean for your life? What freedom will it give you? Now, I know it's easy to get caught up in the noise. The media, politics, Newsom's latest policy, the next election. But let me tell you something. None of that matters if you have enough compelling reasons to succeed. My mentors have drilled this into me. Chris, if your why is strong enough, you'll figure it out. Tenant right groups, new legislation, doesn't matter. You'll find a way to push through. And here's the truth. If you're just holding on to your properties, especially under rent control, you already know how that story ends. You're capped on how much you can increase your rents. Maybe 5% plus CPI. That's not going to cut it. But smart investors are using the 1031 exchange to leapfrog over these limits. On average, our clients see probably about a 10 to 15% annual income growth through a 1031 exchange, easily doubling what rent control allows. And once you move into a better property with more upside, these returns just keep compounding. Look, for the amount of money, time, and risk we put into this business, we should be asking ourselves, how do we maximize our rewards? How do we make sure our investments are working just as hard as we are? So how do we practically do this? That's where the 3 pillars of the financial legacy comes in. Pillar 1 is maximization, or increasing your rental rates and thus your cash flow by focusing on specific property improvements that will also increase the quality of your tenants. In Pillar 1, we discuss increasing rental rates beyond the limits of rent control. And I have a video that I've recorded that takes a deep dive on this, and we'll put a link here. But just know for now, Pillar 1 is where we start in order to move to Pillar 2, which is exponential growth. This is about leveraging your newfound equity found in Pillar 1 because now your property is worth that much more, or simply leveraging the equity you have in a property or properties to scale up by acquiring more units. The payoff? Increased income and, more importantly, compounded growth over time as rental rates are increased across a larger portfolio. This strategy accelerates both your cash flow and the growth of your equity and your net worth. And finally, Pillar 3, preparing for tomorrow. This is where we discuss exit strategies, minimizing capital gains, and strategies to ensure you have income to see you through your golden years. I have videos breaking down each of these pillars. Watch them. Start those conversations with your partners, your spouse, anyone in your corner. It's time to get real about where you are and where you need to be. And if you own multifamily properties here in Southern California, my team and I are here to help. We work with investors every day to navigate these challenges, assist them to make smart moves, and to build real wealth that lasts. 2025, it's a new year. This is your time. Let's make it count. Remember, analysts say multifamily investments are still the most preferred asset class when compared to any other type of investment real estate. The fundamentals are strong, but the winners will be those who can adapt to this evolving landscape. As I mentioned earlier, here shortly, I will be recording my annual market roundup to let you know exactly where multifamily property values are and rental rates in the city that you own. This will help you stay informed about your investments. And of course, we will continue to cover the changes in laws, financial shifts in the market, and everything in between when it comes to multifamily ownership. My team and I are here to help you navigate these challenges and seize the opportunities ahead. If you found this video valuable, hit that like button and subscribe to our channel for more insights to help you build your financial legacy in multifamily real estate. Let's make 2025 a winning year for you and your real estate portfolio. Chris German from The Apartment Dealer wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.